what I also thought was interesting, and I want to get into your framework for how an investor might think about investing in the current environment, given some of the potential dynamics that are at play and that we've discussed, right? And I really like your framework of Icarus and Daedalus. And so let's go through that. And then I want to spend a couple minutes on some of the indicators that you proposed and that we started to see in the Twitter sphere on the dealer gamma and some of the basis of ETFs versus index mutual funds, that kind of stuff. But let's talk about the Icarus trades first.
Yeah, and really quickly to close out sort of the influence of dealer hedging. If people have, because the opposite is occurring in single name stocks. So what's interesting is you generally assume that at the index level, there's a lot of call overwriting. In single name stocks, there can actually be a lot of people buying calls, and you've seen that. I hate to say it's sort of the Robin Hood trader Wall Street bets effect, but you've seen a lot of individual investors starting to buy calls in speculative tech names. And there's been a huge influence of dealer hedging there. Again, we probably don't have time to get into that, but for folks who want to learn more, again, I would stress, go follow Ben Eifert. He just did a podcast with Odd Lots that goes through that in detail. And I think it's very illuminating for folks who are perhaps wondering why these tech names keep accelerating upward in a way that seems totally disconnected from fundamentals. I would argue, again, it's these supply and demand effects that are occurring within the market with forced hedging that have nothing to do with fundamentals that are driving this. So to your question, sort of going through this idea of the Icarus and the Daedalus portfolio, when I sort of thought of this, and a lot of your conclusion will ultimately be tied to your belief system, where you have conviction in the ideas. If you believe that this cycle is sort of the virtuous market cycle we're in, and the Fed is always going to step in, and in the Fed we believe, and there's never going to be an issue with that, then I think the conclusion is pinch your nose, close your eyes, buy some levered equities, come back in 20 years. Because things are just going to keep melting up. And yeah, there's going to be some horrible drawdowns along the way, but if you can ignore it, you're probably okay. I don't know how much faith people want to put in the Fed necessarily. Maybe you go out and you do that, and then you buy some volatility on currencies as sort of a hedge of the US dollar collapsing. Maybe you buy some Bitcoin. I don't know. That's all sort of beyond me. But I sort of thought of that as like a trade like Icarus. So we all know a lot of people know the story of Icarus. I remember it from having to take Latin in high school and having to translate it. But the story of Icarus is that his father made him wax wings. Daedalus is his father, a great inventor. They're trapped, and to escape, they make these wax wings. And Icarus ends up climbing and climbing and climbing too close to the sun, and ends up having his wax wings melt, and he falls into the ocean below. And a lot of people remember that part of the story. And they tell us a story of hubris, almost, that Icarus climbed too high, took too much risk, and ended up ultimately perishing for it. And so to me, some of these ideas that I was coming up with, saying, well, if you believe this cycle and you're just going to go all into it, felt to me like they were ideas that had a little bit too much hubris to them, that it assumed that this cycle was correct. And rather, instead of taking sort of a do no harm view of, well, this narrative might be wrong and this might still be a portfolio we can live with, it was a portfolio fully predicated on this idea being right. I think the part of the story most people don't know is the warning that Daedalus gave to Icarus prior to them leaving, which was, don't go too high or your wings will melt. Don't go too low to the ocean or your wings will get bogged down. Take the middle course. And so what I really wanted to stress here was this idea that you could try to lean in to some of these ideas. If you think the market is ultimately experiencing a flight from active to passive, well, then your equity exposure might be just predicated on momentum factors, right? That's totally fine. But you might want to couple that with something that is going to protect you if you expect there to be a great unwind. That if you think this is like a game of musical chairs, that's the game we have to play, but the music's going to stop and there's going to be a chair missing at some point, you're going to want to think about sort of the hedges you can put on, and ideally convex hedges that you can pair with some of these alpha trades or positive carry trades that can work in conjunction with one another and create a more balanced approach.
Right. So you've got a few great charts to try and illustrate this concept. One of them looks like a normal density curve, but the idea I think is when you're in a positive phase of this environment, and so passive flows are driving momentum names higher at an accelerating rate. You've got this convex positive payoff function. You want to own momentum names. You want to own some call options, some far out of the money call options, for example. And then you sort of flip the sign, and there's either some sort of failure of the monetary backstop, or you flip the sign on dealer hedging pressure, and you go into a negative feedback loop, and you want to introduce things like more conservative equities and maybe a trend following overlay to sort of sidestep some of that market risk, and then some tail hedging. Is that generally the implementation framework?
Yeah, and I should stress here, when I was considering this framework, it was around the idea of trying to build a resilient equity portfolio. So it's not going to include things, for example, that are going to necessarily be tremendously tied to an inflation bet or other asset classes. By no means is this meant to be sort of your total portfolio solution, but around this idea that equity for most investors is a huge driver of risk in their portfolio. How can we try to think about building a more resilient portfolio that leans into some of the ideas with a little bit of conviction of this sort of market cycle that's going on, but if it's wrong, isn't necessarily a portfolio that we'd regret holding. And so to your point, the idea here is that if we think markets are going to continue to express this super low vol melt up and then preceded by some sort of crash, a sharp recovery, and a melt up, again, if you don't just want to sort of buy and hold and close your nose and maybe have a little bit of leverage to that, then what you try to hopefully do is create some convexity in the tails. So on the far right, to your point, out of the money calls, which we might argue are going to be depressed in price, at least at the index level, because another way that these dealers are trying to hedge some of all this option selling is not just by shorting underlying stock, but actually selling other options to try to offset their exposure. Well, that can actually have the price of further out options are going to be potentially depressed. So you might buy some of these out of the money calls and get convexity exposure far cheaper than you would have a decade ago. As you move sort of in and say, okay, my regime is no longer that 3 standard deviation melt up 2017, I'd argue anything we've experienced this year after March falling into the same camp, but it's just sort of positive market exposure. Well, again, if you believe in this, sort of move from active to passive and the flow-based influence that can have on cross-sectional security pricing, that would argue for a momentum trade. As we start to think of the other side of the equation, market losses, both occurring slowly as well as those that are repricing very quickly, on the far tail, we want to think about some of these sort of exposures that can create convexity in a sell-off. So this is going to be things like out-of-the-money puts on equity or call options on the VIX. And you can get creative here. You can sort of say, look, they're puts on bubbles and calls on anti-bubbles, and you can do calls on treasuries and all sorts of sort of basis trades. I'll leave that up to sort of the reader, and you can get far more complex in how you implement these things. But again, I think what you're looking for ultimately is convexity in the left tail that is going to be underpriced because these dynamics that we're talking about here, I don't think have been fully appreciated by the market. As we sort of move up to perhaps not rapid cascades down, but sort of just quicker sell-offs, I'm going to talk a little bit about the quality equity here with the idea that we do want some sort of instantaneous repricing, that there's going to be this continued flight to safety within equities, people moving to stronger balance sheets, people moving to lower vol securities. And these are things that potentially you might have to actively harvest, right? So you're going to get this pop in a market crisis. The idea isn't necessarily to buy and hold that, but you might want to harvest that pop that you see, buy some passive exposure, and then as things calm down, roll back into those sort of quality names after you get that pop. And then finally, I included some trend equity here with the idea that I don't wholly believe that these market dynamics can keep the market completely disconnected from the economy at large forever. I do think that there is economic gravity ultimately at the end of the day, and that once you get a rapid sell-off, you do tend to see a lot of these puts reprice to a point that they're no longer really going to be effective going forward as a hedge. And so things like trend and other such strategies may be applicable in that sort of more prolonged drawdown environment where puts are no longer as price effective. So when we sort of think about putting that into a portfolio, the simple idea was, well, I don't know what regime we're going to be in the future. If I sort of think of the three potential regimes of being we hit this melt up dynamic, a meltdown dynamic, or some sort of prolonged decline, what I should really think about doing is breaking my portfolio into those three regimes from sort of a risk-weighted basis. In this case, it's pretty close to dollar-weighted basis, and putting each of those strategies to work for that regime. So for prolonged declines, it's trend equity and things like equity replacement with options. For meltdown, it's a combination of quality equity and out-of-the-money puts. And for melt up, it's a combination of momentum equity and out-of-the-money call options. And the idea here, again, is sort of pairing these positive carry, anti-carry trades together to create a sort of 1 + 1 = 3 scenario, ideally.
You couldn't have had the melt up scenario in green. I mean,
you know, I get a lot of pushback on my colors. That is the number one thing, the feedback I got from this paper.
I'm sure you did. And I guess the proportion of the allocation there sort of broadly reflect the probability weighting that you place on each of these different scenarios and the relative volatility or impact that these different sleeves will have on the portfolio and the different environments.
Yeah, so going back to this idea of do no harm, unless you have a model to forecast either which environment we are in or which is most likely going forward, I would argue that you do want to take that risk-weighted basis. And since most of this is being implemented with pure equity exposure on a risk-weighted basis is almost equal to a dollar-weighted basis. So just from a sort of strategic perspective, thinking about giving equal exposure to these regimes gets you about there. Then the question becomes, okay, well, I just went through a meltdown. If I don't think that sleeve is going to be as effective going forward, should I actually increase my exposure both to melt up and prolonged declines, right? Because that's sort of when we think about maybe sort of a graph as to a state graph as to what states we can move into. Well, a meltdown doesn't lead into another meltdown typically. Once a meltdown is over, you're either prolonged decline or a melt up. So why would you continue to hold a lot of meltdown? And I think that's sort of the next step, next evolution of thinking of how you would work with this portfolio. But again, just going back to a pure strategic basis with no view as to what's coming next, you would want to think about equally providing equal exposure to each of the regimes.